Everything in this video is for educational purposes only. I am not a financial advisor. Always do your own research before making any investment decisions. Everyone is celebrating the Federal Reserve decision right now. Gold just bounced back to $4,200 an ounce. Social media is absolute chaos with screenshots, victory laps, and people claiming they called every single tick. And look, I completely understand why everyone is losing their minds because the FOMC meeting was historic. But here is what you need to understand right now, and this is exactly why I made this video today. The Fed decision that everyone is obsessing over was yesterday's news the exact millisecond it was announced, and the real test, the actual numbers and policy shifts that are going to dictate where gold and silver head for the remainder of this year, are dropping right now, this morning, and almost nobody in the mainstream financial media is breaking it down properly. I am not exaggerating when I tell you that the next 60 days of price action across the entire precious metals complex will be shaped by how the market digests what is happening right now. And if you do not understand what these shifts mean, how the Federal Reserve's internal fractures are widening, and how institutional capital is positioning itself, you are flying blind in one of the most volatile and important stretches for gold and silver we have seen all decade. So do not skip through this video, do not jump ahead, because I am going to walk you through everything step by step, starting with the hidden details of what the Fed actually did at yesterday's meeting, moving into the structural data driving the next wave, and finishing with the aggressive multi-thousand-dollar price targets that the biggest financial institutions on Earth are quietly preparing for. By the end of this video, you are going to understand more about how the precious metals market truly functions than 90% of the traders staring at blinking screens right now. Let us get into it, and welcome back to John A.G. Insights. If this is your first time here, this is the channel where we break down gold, silver, and the global macroeconomic forces that drive precious metals prices, all translated into plain language that anyone can understand. Whether you have been managing an 8-figure portfolio for 20 years or buying your first ounce of physical silver today. No confusing jargon without a clear explanation, no blind hype without hard data. Just honest, rigorous educational analysis designed to help you make smarter decisions with your hard-earned money. If that sounds like value you need in your life, subscribe right now and turn on all your notifications, because the information in today's video is profoundly time-sensitive, and you are going to want to see every update that comes next. Quick disclaimer before we dive in. Everything in this video is strictly for educational and informational purposes. I am not a financial advisor, and you should always do your own thorough research before making any investment decisions. All right, let us start with a forensic breakdown of what actually happened at yesterday's Federal Reserve meeting. The central bank wrapped up its two-day policy meeting and announced that it was holding interest rates steady at the 4.25 to 4.5% range. And on the surface, to a casual observer, that might sound completely uneventful, a boring non-event where the Fed did nothing and the status quo was maintained. But if you stop there, you miss the entire story. And that missing story is where our education begins. The vote on this decision was not unanimous, and in fact it was fiercely contested, ending with a rare and startling split that sent shockwaves through the institutional trading community. Members of the Federal Open Market Committee did not just quietly fall in line. Multiple members officially dissented, pushing back against the consensus in a way we have not seen in years. When central bankers start openly breaking ranks, it tells you that the internal consensus has completely shattered, and that the debate inside the Eccles building is no longer about fine-tuning the economy, but about a fundamental disagreement over whether inflation is defeated or making a dangerous comeback. Fed leadership stepped up to the podium and acknowledged this tension directly, admitting that the internal discussions were intense, real, and entirely unfiltered. That kind of candid language from central bank leadership is exceptionally rare, and it signals to anyone paying attention that the Fed is flying without a reliable instrument panel right now, caught between a slowing economic engine and sticky, persistent inflation. Now let me explain why a rate hold in this specific environment is so profoundly meaningful for precious metals. Gold and silver do not pay dividends, they do not issue quarterly earnings reports, and they do not generate interest income. They simply sit there as pure, unyielding monetary assets. Therefore, when interest rates are forced higher, investors can earn guaranteed, risk-free yields from government bonds, treasury bills, and high-yield savings accounts, creating what economists call the opportunity cost of holding gold. When holding cash or bonds pays you 5%, holding an asset that pays 0% becomes expensive in terms of the yield you are giving up. And that opportunity cost naturally places downward pressure on precious metals. But when the Fed pauses, when they hold rates steady and signal that the era of aggressive hiking is over or pausing, that immediate threat of rising opportunity costs evaporates. Going into this meeting, a significant portion of the market was terrified that the Fed might surprise everyone with a hawkish hike to combat lingering price pressures. And that fear had caused institutional short selling and positioning that put gold under severe pressure earlier in the week. When the Fed officially announced the hold, all of that defensive positioning had to be violently unwound. And that massive wave of short covering and rapid repricing is exactly what rocketed gold from its pre-decision levels straight past $4,200 in a matter of hours. That is a massive move, driven entirely by the shifting psychology of rate expectations. But it is also a warning shot that the market remains hypersensitive to every single word coming out of Washington. However, the real story of yesterday's meeting isn't just that they held rates, but that the hawks on the committee are gaining momentum, meaning the debate over the next move is fiercer than ever. And that brings us directly to the data and the forward-looking expectations dominating the market right now. According to the CME FedWatch tool and institutional order flows, the probability of what the Fed does next meeting is shifting by the hour, and the market is scrambling to price in whether the central bank will be forced to pivot back toward tightening or forced into cutting prematurely because cracks in the broader economy are beginning to widen. This brings us to the core of why today matters more than yesterday. The Fed makes its decisions based on lagging economic indicators, and those indicators are dropping in a rapid-fire sequence right now, forcing the market to constantly reevaluate its bets. When we look at the Personal Consumption Expenditures Price Index, the Fed's absolute favorite, most heavily guarded metric for measuring true consumer inflation, we see a stubborn gap sitting well above the central bank's stated 2% target. While the media loves to obsess over the headline Consumer Price Index because it makes for dramatic evening news headlines, the folks inside the Fed are staring at core PCE, which strips out volatile food and energy to reveal the underlying structural heartbeat of inflation. And right now, that core PCE print is refusing to cooperate with the Fed's narrative of a smooth, painless return to price stability. If core inflation continues to run hot, hovering in that uncomfortable 3 to 3.5% zone, it completely validates the dissenting members from yesterday's meeting and proves that the inflation dragon has not been slain. Let me break down what that means for your portfolio, because this is where most investors get completely confused. If inflation data comes in hotter than expected over the next few reporting cycles, the immediate knee-jerk reaction in the mainstream markets is often negative for gold, because algorithms and short-term traders panic, thinking the Fed will be forced to hike rates aggressively to crush demand. But if you zoom out past the algorithmic noise, persistent inflation well above target is the single most bullish long-term environment for precious metals in existence. High inflation destroys the purchasing power of fiat currency, turning cash into a melting ice cube. And when people realize that central banks cannot bring inflation down to 2% without blowing up the financial system, they flood into hard assets like physical gold and silver as the ultimate wealth preservation lifeboat. On the flip side, if the incoming data shows the economy rolling over, growth slowing down, and inflation finally breaking, the narrative instantly flips to imminent rate cuts, which crushes bond yields, drops the US dollar index, and gives precious metals an unhindered runway to smash through overhead resistance and push toward entirely new all-time highs. That scenario, where growth slows down while inflation refuses to die, is the classic definition of stagflation. And if you look back at the historical playbook of the 1970s, stagflation is the ultimate breeding ground for explosive, multi-1,000% bull markets in gold and silver. While retail investors and day traders are fixated on these monthly data prints and daily price swings, there is a massive, silent accumulation happening underneath the surface of the global financial system that completely changes the long-term calculus for precious metals. And that is the unprecedented buying spree being executed by sovereign central banks. According to the latest data from the World Gold Council and International Reserve Tracking, central banks around the globe are buying physical gold at a pace that shatters historical records, adding hundreds of tons to their sovereign vaults quarter after quarter without skipping a beat. Central banks in emerging economies, led by nations like China, Poland, Singapore, and India, have been stacking gold month after month for nearly 2 years straight, continuing their aggressive purchases even during periods when Western markets were panicking and gold prices were facing heavy downward pressure. Think about what that tells you for a moment. The institutions that manage trillions of dollars in sovereign wealth, the entities with access to the highest level geopolitical intelligence on the planet, are systematically divesting from paper currency reserves and replacing them with physical gold. They are not day trading the FOMC minutes. They are not reacting to algorithmic panic on social media, and they are executing multi-decade structural strategies to insulate their nations from currency debasement, financial weaponization, and systemic instability. This institutional, sovereign bid creates an impenetrable structural floor underneath the gold market that has nothing to do with what the Fed chairman says at a press conference. And even if short-term traders try to flush the market, these central banks are there to absorb every single ounce, acting as a relentless, patient buyer of last resort. Now, we cannot talk about precious metals without diving deep into the incredible setup currently unfolding in the silver market. Because while gold gets the prestigious headlines, silver is where the asymmetric, explosive opportunities often live. Silver is currently trading in a range that represents an incredible coiled spring when you look at its dual nature as both a precious safe haven asset and an indispensable industrial metal. Over half of all global silver demand comes straight from critical industrial applications, led by the massive, unstoppable expansion of the global solar energy sector, electronics manufacturing, artificial intelligence hardware infrastructure, and advanced medical tech. The Silver Institute has repeatedly confirmed that the world is currently trapped in a multi-year structural deficit, meaning that global industrial and investment consumption exceeds total mine production year after year after year, with the deficit being plugged entirely by drawing down existing above-ground stockpiles. When you drain physical inventories year after year, you eventually approach a critical tipping point where the available supply in commercial vaults drops to razor-thin levels. And when industrial users are forced to compete with retail investors and sovereign buyers for shrinking physical supplies, price spikes are not just a possibility. They are a mathematical certainty based on basic supply and demand economics. Furthermore, the gold-silver ratio, which measures how many ounces of silver it takes to buy a single ounce of gold, sits at a historically attractive level that suggests silver is drastically undervalued relative to its yellow counterpart. When this ratio begins to compress and silver starts outperforming gold, it signals a massive influx of capital into the industrial precious metals space, often preceding parabolic moves that leave latecomers scrambling. Major global financial institutions like Commerzbank, JPMorgan, and RBC Capital Markets have updated their long-term forecasts accordingly, with institutional price targets for gold pointing toward the $4,500 to $4,800 range over the next 12 to 24 months, while silver targets sit comfortably poised for explosive double-digit percentage gains from current levels. To help you navigate these markets like a professional, rather than a gambler guessing at charts, let us map out the exact price levels, support zones, and resistance barriers you need to have marked on your screens right now. For gold, $4,200 is the psychological battleground. The fact that we bounced back to this level following yesterday's Fed decision is a major technical victory for the bulls. But to sustain this momentum, gold needs to build a firm consolidation base above this line. The next major overhead resistance sits at $4,300, where a dense concentration of options positioning and profit-taking orders reside. And once that ceiling is decisively broken and retested as support, the path toward $4,500 opens wide up. On the downside, if macroeconomic data causes a temporary shock, $4,100 is your first line of immediate support, with the ultimate institutional accumulation zone sitting down at the psychological $4,000 level, where deep-pocketed buyers and central banks have repeatedly stepped in to defend the market. For silver, keep your eyes locked on the major psychological resistance barrier around the $60 mark. A sustained, volume-backed breakout above that level opens the door for a rapid sprint toward $65 and beyond, while any short-term pullbacks toward $55 should be viewed through the lens of the ongoing structural supply deficit as exceptional long-term accumulation opportunities. Keep a close eye on the US dollar index, or DXY, as well. If the dollar breaks above key resistance following incoming inflation data, expect temporary headwinds for metals. But if the DXY rolls over and breaks support, expect gold and silver to accelerate upward with absolute fury. Looking ahead between now and the next major policy meeting, the economic calendar is an absolute minefield of high-impact catalysts that will dictate every move we make. In the coming weeks, we have the latest consumer price index inflation print, followed closely by employment reports, retail sales figures, and then the critical Jackson Hole Economic Policy Symposium, where central bankers from around the world gather in Wyoming to signal their long-term monetary policy shifts to the global markets. Every single one of these data points will be dissected, micro-analyzed, and weaponized by algorithmic traders trying to second-guess what the Fed will do at the next FOMC meeting, and precious metals will react violently to every single surprise. This is precisely why education, preparation, and emotional discipline are your greatest weapons as an investor. The person who understands how inflation metrics work, who knows why central banks are hoarding gold, who reads the structural supply deficits in silver rather than panicking over a daily red candle, that person possesses an unshakable structural advantage over the crowd that simply stares at price tickers and panics at every headline. Knowledge does not eliminate risk, but it eliminates panic. And in the high-stakes world of global finance, eliminating panic means making clear, calculated, profitable decisions. Now, before we wrap up this comprehensive breakdown, let us do what this community does best: engage, share, and build collective intelligence. Drop a comment right down below and tell me what your prediction is for the upcoming inflation and GDP data releases. Do you think the numbers are coming in hot above expectations, cooling down rapidly, or landing right in the middle? And how are you positioning your portfolio for it? I read the comments, I want to know your thoughts, and the collective wisdom of this community is one of our greatest assets. If you extracted value from this deep dive analysis, hit that like button right now. I know it feels like a small click to you, but the YouTube algorithm uses early engagement to determine whether vital educational content like this gets pushed out to thousands of independent investors who desperately need it. So your single click genuinely helps others find the truth. If you haven't already, subscribe to John AG Insights and make sure your notification bell is turned completely on with all alerts enabled. Because the second those critical data prints drop or the market makes its next major structural move, I will be right back here with an emergency breakdown to keep you ahead of the curve. Thank you for watching. Thank you for being an essential part of this growing community of smart, independent thinkers. And thank you for investing the most valuable asset you possess, your time, into building your financial education. That single decision will pay compounding dividends for the rest of your life. Stay sharp, stay educated, and as always, stay ahead of the shift. I will see you in the next one. Peace.